Whether you're starting a business, buying a business, or expanding your business, your SBA lender is going to ask for projections. Projections tell the lender what you, as the business owner, think the business is going to do in terms of numbers. How much revenue the business will generate, what are the expenses, the net profit, and that's going to be for the next 2 years. Aside from the numbers, you're also going to be asked for the assumptions. The assumptions are the mathematical logic that you use to arrive at those numbers. In other words, show your work. Now, if you have an existing business, a lot of these assumptions are going to be based on your historical financials. But if it's a startup business, you obviously don't have historical financials. In that case, it's just going to be based on whatever metrics or data you can get your hands on. In this example that I'm going to show you today, I own a grocery store. And I'm in 10,000 square feet, and I'm looking to expand my grocery store into 15,000 feet and add a deli, a fish department, and a bakery. Is it weird that I'm excited to do this? This is how I spend my Saturday nights. I don't know about you.
The first thing I'm going to do is pull up last year's profit and loss statement. So last year I did over $1.25 million in revenue. Last month I did $105,000 in revenue, and adding a deli, a bakery, and a fish department is going to add a total of $45,000 in monthly revenue to the store. And so I'm going to start generating $150,000 a month starting in month 1. Now I need to show you how I got to that number. Maybe I did some research and I know that we can sell 50 pounds of deli meat a day at an average price of $10 a pound. And that's going to produce $15,000 of revenue. And then maybe I have a similar assumption for the fish. $10 a pound, 50 pounds a day. And that's $15,000 of revenue. And then the bakery also, I'll expect to generate $15,000 of additional monthly revenue. And to do that, I need to sell 400 cakes a month at $25 a pop. And then the rest of the revenue is based on bread sales and bagel sales. And I need to run the bread makers at 70% capacity to achieve this. So those are the types of assumptions that your banker is going to be looking for. To give you another example, you can say, well, I'm in 10,000 feet now, and I'm going to increase by 50%. So that's going to help me increase my revenue by 50%, just to give you another idea of an assumption. I have sales tax in this P&L. You're probably not going to have sales tax, but just to make it consistent, I'm just going to put that up here. So essentially we have our revenue number, and the sales tax is 7% of the gross receipts. So again, you won't have to put that, but since we have it on the P&L, I just want to be consistent so that we can show you the projections. Cost of goods, last year, $851,000. That's 67% of the gross receipts. So we're going to use that same assumption here to get to our cost of goods sold. And then the gross profit would be that revenue minus the cost of goods sold, which is a 33% gross profit margin. Now, I'm hearing from my suppliers that the cost of inventory is going to be going up next year by 3% on average, and I want to maintain my margins. So I need to increase my prices by 3% to do that. And so I'm going to increase my monthly revenue, and then I'm going to add that as an assumption so that the banker understands prices are going up and I'm going to increase my prices to maintain my margins. Now we'll just run through the operating expenses. Again, just kind of going off the P&L. The first one is salary and wages. Last year was about $30,000, which is $2,500 a month. And I'm going to have to hire 3 full-time employees for this expansion at $15 an hour. So there's my assumption, and that's another $7,800 a month on top of the existing $2,500 a month. So I'm going to add that into my assumptions. Then you have payroll taxes, which are 6%. That's a formula you can just input into Excel. Rent is staying the same, but the space is 50% bigger. So based on my new lease, the rent will be $4,000 a month. And so I will input that here and I'll just add the assumption. Maintenance was minimal, so I'm just gonna spread that out. It was $720 last year. So we'll just up it slightly with the slightly bigger space. Insurance, I got a quote for $5,000, just up a little bit. So that's $416 a month. Interest, we're gonna base that on our loan that we're applying for, $500,000 at 6%. Utilities, looking at last year, and then adding 50% for the 50% increased space is my assumption. I did not have marketing expense last year, but we want to take out a full page ad in the paper for $500 a month to promote our new products. So I think you get the gist of it, so I'm going to just skip ahead. Now let's total up the expenses. And net income would be the gross profit minus the expenses. Now, since this business is not seasonal, I'm gonna essentially copy all these numbers across all 12 months. However, if there was a seasonal component, it would be very important to just adjust the revenue expenses depending on the time of the year. So then essentially we're just going to total up all 12 months so that we can see what it looks like for the year. Then we'll just copy that straight down so that the formulas will copy, clean it up a little bit. And as you can see in year one, we're projecting a profit of $188,000. And then in year two, I'm going to keep it pretty simple. I'm just going to expect 5% growth. So 5% growth, sales tax would still be 7%. So you have your net revenue. Cost of goods sold, we're going to maintain the same margin, so I'm just copying it over. Same thing with gross profit. And then operating expenses, so salary and wages, we're going to give the employees next year a cost of living raise of 3%. And then the payroll taxes would be 6%. And then we're going to expect all of the other expenses to remain the same in year two. And we'll just copy that down, total up the expenses, and let's see what our net profit is in year two. So the net profit is $209,000. We'll add our assumptions for the expenses and revenue that we are adjusting for in year two. And that's pretty much it. This is a pretty realistic and well thought out set of projections that your banker is sure to understand and be comfortable with. And we'll just go back and add these projections, even though we're just basically saying they're the same as before, just to make sure it's fully complete. There you have it.
See, that wasn't so bad, was it? I know these are just numbers on paper right now, but what these numbers represent is the future cash flow being generated by your business, which you're going to use to reinvest back into the business and continue to build your small business enterprise. So it's very exciting if you're like me, you like numbers, but if not, just grab a cup of coffee, open up Excel, start plugging away. So there you have it. If you found that video helpful and you want more insider tips from an actual SBA lender, I would invite you to click that subscribe button because I've got plenty more where that came from.